Would you like to wake up to money every day? While it's a dream for most, some persons are making it their reality. Today, we're talking about generating passive income with cryptocurrency, but with a twist. We're diving deep into a secret that most people in the crypto space don't even realize: finding the yield. See, everyone throws around these crazy percentages, 10%, 20%, even higher, on their crypto investments, but oftentimes there's a catch, and that catch is understanding the difference between nominal yield and real yield. Nominal yield is like the sticker price. It's the advertised rate you see without taking other factors into account. Real yield, on the other hand, is what you actually earn after accounting for things like inflation and platform fees. And trust me, that difference can be huge. So buckle up, because in this video, I'm breaking down 5 popular passive income strategies in crypto, showing you the tricks to uncover the real yield and helping you maximize your returns. Alright, let's kick things off with staking. Now, if you're familiar with the crypto space, you've probably heard of staking. It's often touted as the easiest way to earn passive income. Essentially, you're locking up your crypto to help secure the network and earning rewards in return. Sounds pretty straightforward, right? Let's take a look at an example. Say you're interested in staking Atom, the native token of the Cosmos network. You head over to a website like stakingrewards.com, a popular platform for comparing staking rewards across different cryptocurrencies. You find Atom and see that it has a staking rewards benchmark of 17.91%. Looks pretty good, right? Almost 18% annually just for holding your Atom. But here's where things get interesting and where understanding real yield becomes crucial. If you scroll down on that same stakingrewards.com page, you'll find another important piece of information: the inflation rate. For Atom, the inflation rate is currently around 12%. This means that while you're earning 17.91% in staking rewards, the supply of Atom is also increasing, which can dilute the value of your holdings. Now, this doesn't mean staking is a bad idea, but it does highlight the importance of looking beyond the advertised rates and understanding the real yield. In the case of Atom, while the nominal yield might be 17.91%, the real yield, after accounting for inflation, is closer to 6%. Remember, inflation is like a hidden tax on your investments. When the supply of a cryptocurrency increases, it can decrease the value of each individual token over time. So, even though you're earning rewards, the purchasing power of your holdings might not be increasing as much as you think. This difference between nominal yield and real yield is crucial to understand, especially in the world of crypto, where inflation rates can be much higher than traditional assets. It's not enough to just look at the advertised rates. You need to dig deeper and understand the underlying economics of the asset you're investing in. In the next section, we'll explore how you can use this knowledge to your advantage and find staking opportunities that offer a truly attractive real yield. So stick around. So how do you find the best staking opportunities in the crypto market? Well, the first step is to always factor in inflation. Look for cryptocurrencies with a healthy balance between staking rewards and inflation rates. Next, it's crucial to choose your platform wisely. Different platforms offer different staking rewards and have varying levels of security. Do your research, compare rates, and opt for reputable platforms with a strong track record. Security is paramount in the crypto world, and staking is no exception. Choose a secure wallet to store your assets and be wary of phishing scams or suspicious platforms promising unrealistic returns. Remember, if it sounds too good to be true, it probably is. And finally, don't put all your eggs in one basket. Diversify your staking portfolio across multiple cryptocurrencies and platforms. This helps mitigate risk and ensures that even if one investment underperforms, it won't significantly impact your overall returns. Now let's dive into a more advanced staking strategy called restaking. Imagine this: you've staked your crypto, you're earning rewards, but you want to take your passive income game to the next level. That's where restaking comes in. Restaking essentially allows you to take your staked assets, which are already earning you rewards, and redeploy them into other DeFi protocols to generate even more yield. It's like a double whammy of passive income. Think of it like this: you've got a rental property that's generating a steady stream of rental income, but instead of just pocketing that income, you decide to invest it in another rental property, further amplifying your cash flow. That's the basic idea behind restaking. Let's say you've staked your Atom tokens and you're earning a decent yield, but then you discover a decentralized lending platform that offers attractive interest rates on Atom deposits. With restaking, you can use your staked atom as collateral to borrow another cryptocurrency, which you can then deposit on the lending platform to earn additional interest. Of course, like any investment strategy, restaking comes with its own set of risks. The most significant risk is smart contract vulnerability. Because restaking often involves interacting with multiple DeFi protocols, it increases the potential attack surface for hackers. Another risk to consider is the complexity of managing multiple positions across different platforms. Restaking requires a deeper understanding of DeFi protocols and a higher risk tolerance than simply staking your assets. So, while restaking can be a powerful tool for maximizing your crypto returns, it's essential to proceed with caution, do your research thoroughly, and only invest what you can afford to lose. Now you might be thinking, this sounds complicated. Is restaking really worth it? Well, the answer, like most things in finance, is, it depends. If you're new to the crypto space or have a low risk tolerance, restaking might not be the best strategy for you. It's generally more suitable for experienced investors who are comfortable with the risks involved and have a good understanding of DeFi protocols. However, if you're willing to put in the time to research and understand the risks, restaking can offer a lucrative way to supercharge your passive income in the crypto market. It's all about weighing the potential rewards against the risks and making an informed decision based on your individual circumstances. In the next chapter, we'll explore another popular passive income strategy in the crypto world: liquidity providing. So, be sure to stick around to learn more about how you can put your crypto to work and potentially earn some serious returns. Let's dive into liquidity providing, or LPing. LPing is a way to earn passive income in the crypto space. You provide liquidity to a decentralized exchange, or DEX. These DEX need assets in liquidity pools to facilitate trades. In return, you earn a share of the trading fees. It's like being a silent partner in a business. But remember, higher returns come with increased risk. Always do your due diligence before investing. Now let's talk about the types of assets that are best suited for liquidity providing. One important concept to understand is correlation. In simple terms, correlation refers to how closely the prices of two assets move together. If two assets are highly correlated, it means their prices tend to go up and down in tandem. When it comes to LPing, it's generally considered a best practice to pair assets that are highly correlated. Why? Because when assets are correlated, the risk of impermanent loss, which we'll discuss in detail shortly, is significantly reduced. Think about it this way. If the prices of your paired assets move in a similar direction, the overall value of your liquidity pool is less likely to fluctuate drastically. This is particularly important when providing liquidity to pools with stablecoins like USDT or USDC. Since stablecoins are designed to maintain a peg to the US dollar, pairing them with other stablecoins or assets that exhibit similar price stability can help minimize the potential for impermanent loss. Remember, the goal here is to generate passive income while preserving your capital. So, when choosing your LP pairs, prioritize assets that have a strong historical correlation. This strategy can help you maximize your returns while mitigating some of the inherent risks associated with liquidity providing. But, as always, remember that past performance is not indicative of future results, and diversification is key. Alright, let's talk about the elephant in the room when it comes to liquidity providing impermanent loss. Now, I know the name sounds a bit intimidating, but bear with me. Essentially, impermanent loss occurs when the value of your LP tokens, the tokens you receive in exchange for providing liquidity, decreases compared to simply holding the underlying assets separately. Here's how it happens. When you provide liquidity to a pool, you're committing to maintaining a specific ratio of the two assets. As traders swap one asset for the other, the price ratio within the pool fluctuates. If the price of one asset in your pair significantly outperforms the other, you'll end up with more of the lower performing asset and less of the higher performing one when you eventually withdraw your liquidity. This can result in you having less overall value compared to if you had simply held the assets separately. The good news is that impermanent loss is, well, impermanent. If the price ratio returns to its original state, you haven't actually lost any money. However, if you withdraw your liquidity while the price ratio is still skewed, the loss becomes permanent. The key takeaway here is that impermanent loss is a risk inherent to liquidity providing. It's crucial to understand this risk and factor it into your overall investment strategy. DeFi lending platforms let you become the bank, essentially. You deposit your crypto and borrowers pay you interest. Think of it like a decentralized version of traditional lending. Aave is a great example of a blue-chip protocol. You can deposit a variety of cryptocurrencies on Aave and earn a passive income. Yields can fluctuate based on supply and demand, but blue-chip DeFi platforms offer a relatively stable way to earn yield. Always be aware of the risks involved. Alright, let's move on to another interesting area of DeFi lending. Let's talk about real-world asset protocols, or RWAs. These protocols bring real-world assets like US Treasury bonds on-chain. You can invest in tokenized versions and earn yields tied to their performance. For example, buy a tokenized US Treasury bond and earn a yield based on its interest rate. This offers exposure to traditional assets with DeFi benefits like transparency and accessibility. But remember, there are risks like regulatory uncertainty and potential default. Always do your research before investing. Navigating DeFi lending can seem daunting, but it doesn't have to be. Start by doing your research. There are tons of resources available online. Take your time, learn the basics, and don't be afraid to ask questions. Once comfortable, start small and diversify your investments. Always be aware of the risks. Let's talk about centralized exchanges, or CEX. You might think they're the opposite of DeFi, and you'd be right in a way, but CEX offer interesting passive income opportunities. Crypto savings accounts are common. They work like traditional savings accounts, but you earn interest on your crypto. Interest rates are typically higher. Another option is dual asset products. Earn interest and gain exposure to another asset. You deposit crypto, and the exchange lends it out. You receive interest in stablecoins. It helps hedge against volatility. Liquidity mining is another option. Provide liquidity and earn trading fees. It's a great way to earn passive income. Now you might be wondering, why would I use a centralized exchange for passive income when I can get similar products in the DeFi space? And it's a fair question. But there are a few key advantages that CEX offer. One of the biggest is convenience. Centralized exchanges are generally much easier to use than DeFi platforms, especially for beginners. They have user-friendly interfaces, 24/7 customer support, and they're generally more accessible to the average person. Another advantage is security. Now, I know what you're thinking. Aren't centralized exchanges notorious for being hacked? And it's true, there have been some high-profile hacks in the past, but the reality is that centralized exchanges have invested heavily in security in recent years, and many of them now offer institutional-grade security measures. And let's not forget about liquidity. Centralized exchanges have much higher trading volumes than DeFi platforms, which means you're more likely to get a good price when you buy or sell your crypto. This is especially important for larger investors who need to be able to move their money quickly and efficiently. So, while DeFi platforms are catching up, CX still have a clear advantage in terms of liquidity. Now, before you go all in on centralized exchange products, it's important to proceed with caution. While these products can offer some attractive yields, they also come with their own set of risks. One of the biggest risks is counterparty risk. When you deposit your crypto into a centralized exchange product, you're essentially trusting that exchange to keep your funds safe and to honor their end of the bargain. And while most exchanges are reputable businesses, there's always a risk that something could go wrong. Another risk to be aware of is platform risk. Centralized exchanges are centralized, which means they're controlled by a single entity. This gives them a lot of power, and it also makes them a target for hackers and regulators. If a centralized exchange were to be hacked or shut down by regulators, it could have a significant impact on the users of that platform. And finally, you need to be aware of the potential for hidden fees. Centralized exchanges are businesses and they need to make money. While they may advertise low fees or even no fees, they often make up for it in other ways, such as by charging higher spreads on trades or by imposing withdrawal fees. So, it's important to read the fine print carefully and to make sure you understand all the fees involved before you use any centralized exchange product. So there you have it, 5 powerful strategies for generating passive income with crypto. From the exciting world of DeFi to the familiar ground of centralized exchanges, there's an option out there for everyone, regardless of your risk tolerance or experience level. Remember, the key to success in the crypto space is to do your research, start small, diversify your investments, and always be aware of the risks. Now I want to hear from you. What's your go-to passive income strategy? Are you a DeFi devotee or a CEX enthusiast? Drop a comment below and let me know your thoughts. And if you found this video helpful, smash that like button, subscribe to the channel, and turn on notifications so you never miss another breakdown. Thanks for watching and good luck out there.